Mortgage interest rates are going up. What should you do? Ted and I have some thoughts starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
We are recording this on July the 18th, 2022. Is that correct? Have I got my dates right here?
A day that will live in infamy.
No doubt. At the start of this year, according to my cue cards here, the Bank of Canada target overnight rate was 0.25%. That's a quarter of 1%.
Yep.
Now, I realize that's not the rate you get at the bank, but that's kind of the starting point. It has increased 4 times since then in March, April, June, and the latest increase, a full percentage point on July 13th. So today, the Bank of Canada target overnight rate is 2.5%. So, first question for Ted Michalos, how much bigger is 2.5% compared to 0.25%?
I don't have a calculator with me, but let's say 10 times bigger.
10 times is the correct answer, and that's, of course, after the...
And what were my predictions in January?
We'll get to it. We'll get to it. We won't talk about my predictions because, they haven't exactly worked out. So, July 13th, it was a full 100 basis points increase. That's a full 1 percentage point.
Right.
That's the biggest increase since 1998, which is before you and I were born, according to my notes. I don't know if that's true or not, but let's assume it.
Born again, perhaps.
There you go. A 3-year variable rate is still available as we record this again in July for just under 4% if you got great credit. A 5-year fixed is just under 5%. So those rates are obviously a lot higher than they were a few months ago.
Yep.
So the topic today, if you're renewing your mortgage or getting a new mortgage, what are your options? So let's start with the basics here. And so some of you will already know all this stuff, but I want to make sure we're all on the same page. To qualify for a mortgage, you go into your bank or you talk to your mortgage broker.
Whomever's giving it to you.
Whoever's giving it. You have to have good credit, and the property you're buying has to have sufficient value, and you have to have sufficient income.
Right.
How do they figure all that stuff out? With good old LTV. Tell us what LTV means.
Well, I'm sure it's got nothing to do with ATV vehicles.
No, that's a different thing.
Loan to value.
And the concept being that they're not going to lend you the full value of the house.
Well, and on top of that, their value of the house is probably different than the market value of the house. So lend to value is they're going to determine what they believe the safe price for your home would be, and they're going to lend you, well, if it's a conventional mortgage, up to 80% of that value.
There you go. So, I mean, it could be higher, could be lower,
right? But
you're not getting a full 100%. Okay. What is mortgage insurance?
So mortgage insurance is one of the biggest boondoggles that was ever created. So you go to the bank, you take out a mortgage, and then they give you insurance that'll cover those mortgage payments in case something goes wrong with you. In other words, you die. So it's not for employment insurance or something like that. It's got to be something pretty dramatic for mortgage insurance to kick in.
Yeah, and I'll put a link in the show notes to the cost of mortgage insurance with CMHC. There are other mortgage insurers as well. And the deal is...
Well, we're talking about different things. So.
Yeah, so you're talking about sort of a life insurance component of the mortgage if you're dead.
Right, you're talking about the mandatory requirement to have mortgage insurance
which is also a boondoggle.
Right.
So CMHC is the biggest... Well, they used to be. I assume they're still the biggest mortgage insurer. Put a comment below if I'm wrong.
Right.
And the rule is if you have 20% or less of a down payment, then you have to have mortgage insurance. The lower the down payment, the higher the insurance premium.
Right.
So it can be up to 4% if the loan to value is 95%.
And it's added to the purchase price transaction. It's not a premium that they charge you over time. Yeah. You pay it up front and you pay mortgage interest on it over the life of the mortgage.
You're getting whacked right off the bat.
Twice,
so if you had an 80% loan to value, the insurance rate is 2.4%, which is still really huge.
Right.
So you said it was a boondoggle, and I agree with you. Who is protected by that mortgage insurance?
The mortgage company. So the people lending you the money. It's got no protection for you whatsoever. So let's say if something goes horrible and the house has to be sold, you've lost your job, somebody died. It really doesn't matter what horrible thing happened to you. You can't pay your mortgage. The mortgage company steps in, they sell your house, and they sell it for less than you owe them. So the thing that happens is their insurance kicks in and CMHC pays them the difference. CMHC then has the right to come after you at some point and say, well, wait a minute, you owe us for this shortfall that we had to pay out on the insurance premium.
So heads you lose, tails you lose.
Correct.
It's what you're describing.
It's a horrible situation.
So the bank, the lender's covered,
Right.
You're picking up the shortfall, even though you paid all this money for mortgage insurance.
Correct.
That sounds like a bit of a scam. Now, obviously, I guess the counter argument to that would be, well, if I'm a banker, I don't want to be lending money because I might lose. So with the government, CMHC backstopping me, then I don't have to worry about it. So I guess maybe they're more likely to give you a mortgage than otherwise.
So, and that's the argument for you getting the best possible interest rate as well, because this is a debt that, as far as the lender is concerned, they're protected 3 ways to Tuesday. I mean, they're not going to lose money on this no matter what happens.
Which is why, even with interest rates having gone up, they're still fairly low compared to historical standards.
Right.
Okay, let's get back to the initials. What is GDS?
Gross debt service ratio.
Easy for you to say.
That's right. So it's basically what portion of your income is being used to service your debts.
And okay, simple as that. So you take your monthly mortgage payment, which would include principal and interest, and you would factor in heating, property taxes, condo fees. So the cost of
carrying that house.
Exactly. So I've got an example on my cue cards here. Let's go through the example, shall we? Let's say your income is $7,000 a month.
Okay.
And I know people are going, 7,000, who's got 7,000? Well, I had to do it that way to make the math work, okay?
Well, and we're talking about the total income into the household.
Yeah. So whoever's the borrower here. So if the mortgage is $1,500, you pay $200 a month for heat, property taxes are $500, and condo fees are $300, then the total of all those numbers is $2,500.
Right.
What is your gross debt service ratio?
35.7%.
Simple enough. Now, according to CMHC rules,
right,
your gross debt service ratio may not exceed 39%. So
what that means is CMHC won't insure the mortgage for the lender, which means you won't get approved.
Right. If you have less than a 20% down payment.
Right.
And I guess if you're pushing the limit, you probably don't have the full down payment, so you need the CMHC insurance.
Right.
So that is gross debt service ratio, which, as we said, factors in the mortgage payment and the cost of the house itself.
Right.
What is TDS?
So that's total debt service. And so that includes any kind of debt payments that you're making. So it's going to look at your car payments, your credit cards and other debts as well. Anything. Right?
Total debt service. Right.
Yep.
Now, again, according to CMHC, if you want them to insure your mortgage, your total debt service ratio must not exceed 44%.
Right.
So in the example we just gave where you got $7,000 of income, going from 39% to 44%, that's another 5%.
Right.
5% of $7,000 is $350.
Yep. So that's your debt service. So I guess if you got a car payment, you're in trouble. Now, you may not be, because remember, we were only at 35. Then you can go to 39.
But $350, that's not very much. Yeah. And I believe when we did our Joe Detter, Hoyes and Michalos bankruptcy study,
it was a little higher than that?
Yeah, it was like close to $2,000 a month or something.
Well, but we weren't considering somebody getting a Yugo.
No.
You may not remember what that is.
I do remember. I'm an old man. But the point is, this is a pretty high bar to achieve. Now, final question then. What is the stress test? Because that's the other thing that involves whether you can get it or not.
So CMHC I guess it was, do I blame CMHC? Do I blame the government? I guess I blame the government because they set policy. It was
OSFI, the Office of the Superintendent of Financial Institutions. So yes, it was the government who brought in the stress test.
So it's basically they take a look at the rate now, but what's the projected or possible highest rate in the next 5 years? Can you afford the mortgage at that higher rate?
Right, because they realize that it's possible that interest rates will go up, as they certainly have done.
It's cyclical.
And so as the way it works now, they run the numbers at the greater of 2% more than whatever your mortgage deal is, or the Bank of Canada minimum qualifying rate, the good old MQR.
Right.
Which, as of right now, in July of 2022, is 5.25%. So
right now it's going to be the 2% higher than your contract because people are renewing at 4%.
So it's the greater of 2% more, so 4% plus 2% would be 6%. That would be the rate that would kick in.
And this almost always applies. It's almost always the 2%.
Yeah, and now of course by the time you're watching this podcast in the future, that minimum qualifying rate might have been increased.
Right.
So who knows? Because
it certainly will.
6 months ago, when interest rates were, what did I say? They've gone up
0.25 to 2.5 for the bank rate.
2.25%. Well, you take 2.25% off of that, that's 3%. This might have been the kicker back 6 months or a year ago. So, okay, that's enough background. Let's get to the interesting stuff here. So I want to buy a house. What do I need to do to qualify for a mortgage? How can I set myself up for the greatest chance of getting a mortgage?
So the single most important thing they're looking at is how much money you got coming in. So income. The higher the income, the more mortgage you're going to qualify for.
So whatever I can do to get my income higher.
Yeah, that's legal.
Oh, that's legal. Well,
because they really penalize self-employed people, right? Because they've got their gross income, but their net income for taxes. So you want to have the highest possible taxable income, I guess, which is a little counterintuitive.
Which is bizarre, yeah. But yes, and I mean, I've had Ron Butler on this podcast on numerous occasions, and he's, of course, a mortgage broker with Butler Mortgage, and he tells me that, yes, they actually are checking to see what your income is. It's not like the old days where you could just put a number on a form. So they want to see your pay stubs. Mm-hmm. They want to see your tax return for last year.
Right. And
if you say, well, I'm going to be renting out the basement, okay, have you got a rental contract? Right. Like how locked in is this? So if I'm trying to increase my income, well, not a whole lot I can do. I can get a part-time job or whatever,
right? But
I have to be able to prove I've got that income.
Yeah, for years we've been telling people your expenses can increase overnight. It's almost impossible for your income to. So, but if you're thinking about getting a house for the first time, you're planning this out well in advance. So you don't just suddenly get the urge this weekend, let's buy a house on Monday. All right, let's put the things in place. And the first step is maximize your income.
And obviously this would also apply if you're buying another house and renewing and whatever.
Right.
So, okay, so the next, and you're right, it's easier said than done to increase your income. It's easy for two guys on a podcast to say, just go increase your income.
When's the last time we increased our income?
Yeah, it's been a while.
Let's not go pre-COVID.
Yeah,
anyway.
Pre-COVID. So, okay, how else can I make the mortgage more affordable? Well, that would be to stretch out the amortization period. So explain what is the amortization period?
Well, so this is another one of those horrible boondoggle things, right? The amortization period is the period of time you're going to take to repay the loan. And so the normal expectation used to be 25 years for a mortgage. Now it's not uncommon for 30, 35, I believe 40 is the maximum that they'll write them out to. And so you get a lower payment because you're stretching them over a longer period of time, but you're paying more interest. So you're actually increasing the cost of buying that house significantly.
Yeah, if I've borrowed the money for 10 years or I borrowed it for 25, obviously 25 is bigger than 10. I must be paying more interest even though it's a declining balance as I go. So this confuses a lot of people. Yeah. There's the amortization period and there's the term.
Right.
So amortization period is, in your example, let's say 25 years.
Yep.
What's the term?
So the term for most people is either 36 months or 60 months, depending on the type of mortgage that you're signing for. So and what that means is it's the period of the contract duration. So they're assuming, or they're writing out the mortgage as if you're going to pay it for 25 years, but we're really only lending you the money for 5.
Yeah, we're only fixing the interest rate. That's the biggest term, right?
Yep.
So we're going to lock in the interest rate for 1 year, 3 years, 5 years, whatever the term is.
Yep.
But we know that at the end of 5 years, you won't have paid it off because we've amortized it over 25 years.
And this is something unique to Canada. In the U.S., it's you lock in the contract for the full 25 years, but then you go out and you get a brand new mortgage to pay out the old one. So it's a strange system in the U.S., but the Canadian system, in one respect, this is better because you've got this review, but it's really there to protect the banks. It's not to protect you. So we set the term for 3 to 5 years. And that period is up. If you're lucky, interest rates are stable, and so you're renewing at the same rate or a better rate. If you're renewing right now, you know that sometimes you're unlucky and the rates are just getting ridiculously higher.
Yeah, if your mortgage, if you set your term 6 months ago, a year ago, 2 years ago, 3 years ago, 5 years ago, then the interest rates are almost for sure much higher today than they were then.
Right.
So make sure you understand the difference between length or term.
Amortization period and term, yeah.
And so I've got some numbers here. If we assume a $500,000 mortgage, a 5% interest rate.
Okay.
If you amortize it over 10 years, your monthly payment is $5,200 almost $5,300 a month.
Right.
15 years, it's $3,940 a month. Why is that? Well, because you are stretching it out over a longer period of time, so the number goes down.
Right.
20 years, $3,200. 25 years, $2,900. 30 years, $2,600. So the amount you will pay.
Right, so this isn't interest. This is the total amount you're repaying.
Total amount you pay. So what I did was I said, okay, 10 years, it's $5,290 a month, that 5% interest rate, $500,000 mortgage. I'm going to multiply it by 10 years and then multiply by 12 months and 10 years. So I'm multiplying by 120. I get $635,000.
Okay. So the cost of that mortgage over the 10 years is $135,000.
Exactly. 15 years, it would be $709,000. 20 years, $788,000. 25 years, $872,000. 30 years, $960,000.
Right.
So I am paying almost double.
Yep.
If I'm amortizing it over 30 years as opposed to 10. The difference between 10 years and 30 years is, well, $325,000 on a $500,000 mortgage.
Right.
So that's a huge difference.
What
Now,
does it tell you? Yep.
we're not saying you should always pick 10 years or 15 or 20 or 30.
Because it may not be realistic.
Yeah. I mean, the difference between paying $5,300 a month and $2,600 a month is huge.
Right.
I can't afford $5,200 a month. And because of all these rules we just talked about,
You won't qualify
I
anyway.
won't qualify anyway. So I may have no choice, but you want to understand that by doing that, you're stretching out the period. So, okay, we've talked about having higher income. We've talked about stretching out the amortization period. What else can you do to lower your monthly payment and or qualify for a mortgage?
So there's only one other factor to a mortgage is how much is your down payment. So obviously the more money you put down, the less money you're going to borrow, and therefore the less your interest costs will be.
And that will also affect your mortgage insurance.
Correct.
Potentially. Well, in fact, almost for sure it would be.
Mm-hmm.
So if you can get a down payment of more than 20%, then there is no requirement for CMHC mortgage
So
insurance.
you just saved yourself 2.5% of your purchase price.
So, or more, depending on how much you were going to put in, or less, I guess.
Yep.
But yes, there's definitely a savings on the insurance. And then, of course, well, your mortgage payment's lower because your mortgage is lower.
Right.
Simple as that. So, okay, that leads to the obvious question then. I'm sitting here today.
Mm-hmm.
I want to buy a house.
Yeah, you're too late.
I'm too late.
Ask the question.
So let's, and I agree with you. Well, am I too late or am I too early?
Well, okay, yes, you could be. That's right. If you wait another 6 months, probably that house you want is going to be 10, 15% cheaper.
Yeah, and we're not making predictions here because we'll talk. In fact, tune in next week.
When we'll make predictions.
Yes, because next week on this show, which will be episode number, 413, we will review the predictions we made at the start of this year, and you can see
how we're doing.
See how we're doing. So we'll tune in next week for that. If you're doing the YouTube thing, push that notification thing, and then you'll get that notification when that comes out. So the best time to buy a house was 10 years ago.
Okay.
Maybe 20 years ago. Maybe 30 years ago. Because if you bought a house 30 years ago, almost for sure it's worth more than what you paid for. But let's say that I have to buy a house because I've got 3 kids and 2 dogs and a goldfish, and I've just relocated to a town and there's no rental accommodation, whatever.
Right.
So should I rent for a while and build up more of a down payment, or should I buy now with whatever I've got? And part of it is, well, my down payment, I guess, is somewhere. It's in my investments or something. Right. So it's not just what I think is going to happen to the real estate market. It's what do I think is going to happen to my investments.
Everything else. That's right.
So how has the market been doing over the last few months there, Ted?
Well, so if you went back 6 months ago, the market was doing fabulously. But of course, in this last 6 months, it's pretty much collapsed. Any gains you made during COVID, because there was so much more money supply out there, are gone. And in fact, I think it's probably below, we're at pre-COVID levels again.
And again, it would all depend on where you bought. If you bought right on the absolute bottom day of COVID in March of 2020, you're probably still doing fine.
You're not.
Or maybe not. It depends what you bought.
Depends on what you bought. That's right.
If you bought Netflix stock, then that one kind of got wiped out.
Yep.
And quite a few others. And again, this is not financial advice, so if what we're saying is wrong, leave me a comment. But the point is, so far in the last few months, real estate prices have come down, but so have
everything else.
So,
Well, and are you going to treat your house as an investment too? Right. So one of the questions you're asking is, do I cash out my investments to buy the house? Well, you have to live someplace, but if you're thinking of your house as an investment, you've got to make the comparison you just made. Which makes more sense?
Yeah, and I believe I wrote a book, Straight Talk on Your Money, where I addressed this exact issue, and I said you should not treat your house as an investment.
Right.
Which, of course, everyone disagrees with me on that. But the reason I say that is because I think a house is a place you live.
Right. It's a thing. It's like this pen. I don't treat this pen as an investment. I hope it goes up in value. No, I know I'm going to use it and eventually throw it away.
You don't throw an entire house away,
Right.
but you do have to replace the roof and the furnace and the floor and the carpet and the this and the that. So if you think of a house as a place to live, then it's a lot easier to compare owning to renting.
Right.
Because here's the dollars I have to spend.
Well, and we haven't updated this comparison in years, but the original calculation we did, it cost you 25% more to own than to rent. Those are just the additional costs because you're now responsible for this thing, whether it's upkeep or just higher utilities or whatever. That's the comparison.
Yeah, and even if you were renting the exact same house that you bought, if you own it, you're going to do more with it.
Right. You got a different attitude towards it.
It's my house. So I'm going to spend a little extra on this, and I'm going to make the garden look nice, and I'm going to, fix the roof and whatever.
Right.
So it's and what the exact number is. Now, of course, the math in the past was, well, okay, it cost me more to own, but if it cost me 25% more because I got to pay the property taxes and the maintenance and everything else, but the house is going up by 50% a year.
It's no brainer.
No brainer. You want to own. But when houses have dropped in price over the last few months, it costs me more to own and the price is going down.
Right.
It doesn't sound like such a fantastic
except
thing.
for there's no rental inventory right now either, so the rental prices are going through the roof.
Which is why this is not just a financial decision.
Right.
So again, if you've got a spouse, 2 kids, a dog, and a cat, I can't just live anywhere.
Right.
My kids go to that school over there. I don't want to uproot them.
You got some different priorities, just your finances.
Yeah, and I don't want the landlord to say, "Oh, I'm going to move in, so
Right.
I'm rent evicting you." I'm evicting you. So owning gives you a bit more stability, perhaps.
Yep.
Of course.
Well, for a price.
For a price.
Right.
Now, of course, at the end of a rental deal, you walk away and you're done. If you have to sell your house at a lot less than you paid for it, then there's a burden there too. So
right.
I guess the point is there's, many different factors you got to consider here.
Right.
So you want to look at the obvious things you can do. You want to look at how your investments are doing, if that's what's going into the down payment. I guess the other thing you want to look at is what's your own personal future? What are the chances that you're going to be moving to Alberta in a year for job reasons?
Right.
Would it be better to be owning or renting in that scenario?
What's going to be easier to deal with, right?
And if you've got a month-to-month lease, pretty simple. I say to the landlord, "Hey, I'm gone in 60 days, and I don't have to pay real estate commissions or anything like that. I don't have to worry about what the market's at." So you got to look at a whole bunch of different factors there. So I guess the point is, this is something you have to figure out for yourself.
Right.
It's not something that 2 guys on the podcast can tell you what to do. There are a number of real estate professionals who at the moment are saying this is a fantastic time to buy.
Right.
Because look, the price is 20% less than it was 6 months ago.
Yeah. Of course, the price 6 months ago was 30% higher than it was a year and a half ago.
Right. So there are, a certain segment of the real estate professionals who believe the time to buy is now.
Right.
It doesn't really matter what's happening. It's always a good time. And I guess if you got a 30-year time horizon, that's probably true.
Well, so the odds are over 30 years, you're going to have a winner with a house because land is one of those things they're not making any more of.
They're not making it anymore. Mm-hmm. But if your time horizon is less than that.
Well, and for most of us, if you have a time horizon, if you're planning out more than 5 years, you got to assume that anything after the 5th year really is just it's a hope and a dream.
Yeah.
Because you just can't tell anymore.
It's a total crapshoot. I mean, I guess if you've got 2 kids who are 5 and 7 years old, and you have a job working for a very stable government entity.
Post office?
Yeah, I don't know how stable
used
they
to be.
are, but used to be. We don't have letters anymore. But and that's kind of the key point. What is a stable employer these days?
Right. There's no such thing.
There's no such thing.
Right.
So how you can be projecting out 30 years, I don't know.
All you can do is say that I want my kids to be in the same schools. I want to stay in this neighborhood. This is my 5-year plan. I'm hoping for beyond that.
And the kids may be at a great school right now, but is that going to be a great school 5 years from now?
I guess they rotate the principals.
There you go. So who knows? So I think you got to factor all these things in. So my advice is to do your own stress test.
There you go.
So how would you do that in real life? If you're doing your own stress test, what are the kind of things I'm looking at? I mean, we've kind of already talked about them. But.
Well, so we're stress testing for things other than just money. So first you got to decide, you, your spouse, your family, whatever, what's the single most important thing? Lots of people, when we ask them that question, well, I want to stay in my house. Okay, that's a knee-jerk reaction. Is that really the most important thing? Is the most important thing that my kids stay in the same school? or that I'm close to my parents or my other family members. Like, figure out what's important and then figure out how that's at risk. And that's your stress test. And so that's a non-monetary consideration that I just gave you. You want to stay in the same schools. Then it's, okay, I like to get a new car every 3 years. Well, so if I lock into a mortgage and an expensive payment and something happens to my income, maybe I can't get my car. Well, is my car more important than my house? Only you can tell us that. The family likes to take a vacation every once in a while. Or you know that the kids want to do all of these different activities, piano, ballet, whatever the hell these things are. How is that going to affect your ability to afford a mortgage? What are the family's priorities? That's the short answer.
When was the last time you were at a dance recital?
Oh, what was that? 3 weeks ago? 4 weeks ago? For a whole day.
Oh, that'll be another show for another time.
You don't want to know.
Hey, if you're going to have 3 daughters, what do you expect, right?
Right.
So, yeah, I totally agree with you. And I want to stay in my house, but I also like to have a car.
Right.
I also like to go on vacation. I also like to have a bit of cash in the bank. I like this. I like that.
My kids are going to university in 2 years, in 5 years, in 7 years. I'm going to retire in 2 years, 5 years, 7 years. All of these things are going to set different priorities for you.
And all your crypto investments by
well,
then
yeah,
will probably have quadrupled in value in the next 10 minutes.
So I'm liquidating crypto now to buy cannabis stock because I hear that's a good place to put your money.
Yeah. If this was 5 years ago, you're nailing it. You're kind of like the Bank of Canada. You're fighting the last war and you're always 8 months behind.
There you go.
Let's raise interest rates. We're in the height of a recession. So again, that's another show. We'll edit that out. We don't have to put that in there.
Right.
So bottom line is, yes, do your own stress test, and you got to look at the monetary and the non-monetary. So how long am I going to live here? What's my kid's situation? I like being in this house because it's in the kid's school district.
Right.
Well, if I rented the house next door, I'm probably still in the same school district.
Yep.
The street over.
And do I need the stability of owning versus? I mean, there are all sorts of things that you got to factor in.
And if your math was correct that it is cheaper to rent on a monthly basis, what are you doing with that difference? Right. Are you putting it in a good solid investment and it's growing, or are you spending it on something that's gone? Yeah. That would also help inform my decision. How close am I to retirement? Would also be a factor. Do I want to retire with a house that's paid off? Or when I retire, I want to be living on a cruise ship, going up to cottages, traveling and everything? Right. Can you think of anything more horrible than spending 10 years straight on a cruise ship? Right. Confined to your cabin because of the virus. So again, these are all factors you gotta consider. Yep. Now that's the non-monetary. The monetary, again, I think is fairly straightforward. You cannot assume that whatever the interest rate is today, it will be the same when you renew your mortgage.
You can't assume that you're going to have the same job 5 years from now anymore.
Or tomorrow.
Right.
So, okay, how much flexibility do I have? Interest rates have gone from 0.25 to 2.5
in 6 months.
In less than 6 months.
Yep.
So now we're not saying we're gonna keep going like that. Tune in next week. I guess we'll find out. But can you handle a higher interest rate when your mortgage renews?
What's the impact?
So consider all those questions. That'll hopefully put a bit of context to what you got to do. So there you go. That's our. And I think what we've done is we've thrown a whole bunch of stuff out there.
We sure have.
We have made no conclusions, but that's for you to decide. So there you go. Ted, thank you very much. Hopefully we've given you at least some things to think about. So next week, we're going to talk about what we see as the future. So you'll want to tune in for that.
Your year-to-date update.
There you go. So until then, that is our show for today. Until next week, which is the final show of season number 8. Thanks for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30.